So let's get into this weekly wrap where we wrap the week. We try to make sense of what has happened. Again, Friday afternoons are great for that. Now that we've locked in the Friday session, I did want to start with a poll. If we talked yesterday, one of our 3-and-3 charts was the AAII survey results, and that's a weekly survey of individual investors. We had the idea of just sort of recreating that idea with our StockCharts viewers. So we asked all of you, are you bullish, bearish, or neutral on U.S. stocks for the next 6 months? Here are the results over the last couple of days. 48%, almost half of you said bullish on stocks in the next 6 months. 24% bearish, 28% neutral. So interesting, about 2 to 1, almost exactly, bulls to bears. And that's actually very different than what we're seeing on the AAII poll, which is leaning much more bearish. What's interesting is, the time frame I think is key, right? Some of you, they answered bullish in 6 months. If you think about it, we could drop significantly for the first 3 months, recover beautifully for 3 months, and we'll finish up maybe a little more positive. In which case, that might be a bullish answer if you're thinking 6 months out. So there's plenty of uncertainty in that sort of time frame, which I totally understand. But interesting to hear that all of you, on average, about half of you, leaning more bullish at this point. Now, I have to tell you, as a trend follower, I can totally see what you're saying. The trend overall has been positive. There have been so many, charts. Think of the average technology stock is holding up very, very nicely. Semiconductors, software companies, hardware companies. There's a lot of decent charts, a lot of stakes breaking out. Having said that, I'm always looking in this sort of environment for signs of internal weakness. I think in the last 5 to 7 sessions, we've seen some examples of where there's some chinks in the armor that we want to pay attention to. Let's dig into that a little further now. In terms of how things sort of played out, the S&P finished down 0.5%. If you look at the short, little quick preview chart, you can see the huge gap out today. And I know checking the futures before the open certainly felt like this was going to be a big finish into the end of the week. But then you saw how things rolled over very quickly, and again, a lot of news flow about Apple shutting stores down, about concerns about that, about Fed announcements and all of that. So plenty of potential drivers, but certainly there was a weight on the market as it went below zero right around lunchtime. Since then, it's sort of chopped around a negative territory. At the end of the day, the S&P finished down about 0.5%. Mid caps the same. Small caps down a little more, about 1.3% or so. The Nasdaq 100 ended up flat actually, and spent much of the day in the positive territories. Came back to close right around flat for the day, and the VIX back up to just above 34. In terms of bonds, the TLT actually opened relatively weak and then just sort of improved through the remainder of the day. Finished right about at the close for yesterday, sort of a rounding error, and the 10-year yield up just a little bit to 0.7. Oil prices up higher today, gold up higher as well. So the commodity complex as a whole pretty much in the green, showing some positive rotation to that particular asset class, those assets on that list. Let's look at a chart of the S&P 500 as we begin to think about the implications of what's happened this week. When I look at a chart of the S&P, short term certainly has felt more distributive than positive. And the reason why I'm saying that is I'm seeing a lot of days where we're closing below the open. Only 2 out of the last 7 sessions have closed above the open. So that, during the day, you're seeing more distribution than accumulation. Is how I would think of it. After the big gap down last Thursday, Friday into Monday sort of traded around the 200-day, but bounced up. And as we talked about earlier in this week, I think this week's move certainly would satisfy both sides. If you're bullish, this feels like a buyable dip. If you're bearish, this could feel like the first leg of a multi-leg move down. I think today's close in the last couple days, you look 3 of the last 4 days closing below the open, we've now established a bit of a short-term sort of reaction peak here just above 3150. And I think remaining below that sort of makes the market certainly feel sideways to down. And I think the intraday distribution is what concerns me more than anything on a short-term basis. Having said that, you have to acknowledge the fact that overall the trend remains positive. Higher highs, higher lows. And even though this gap down was significant, we sort of stayed right around that previous swing low, this gap from the end of May. So overall, still in a positive range until we establish a lower high, which potentially we have. And I think going into next week, if we sell off a little further and we see 3150 as the new lower peak, I think that could be a bit of a concern. And then the follow through, we'd be breaking below the swing lows from last week. So at this point, if I had to say anything, it's sort of neutral, which is about where we started the week, to be honest with you, coming out of the gap down last Thursday. I did want to point out very quickly, one of the things I added recently was just looking at some of the weekly changes to get a sense of how the markets have evolved week to week. Thought it'd be an interesting way to just sort of make sense of things. It's just looking at returns during the week. So the S&P actually finished up 3.7%. If you look at the TLT bonds, down 1%. This is the dollar up 0.6% in the form of the UUP. The commodity index up 2.2%. Gold flat for the week, and oil was the best of the group, up 6%. Looking at some other asset classes here, we'll rotate to cap tiers. So this is looking at large versus mid versus small. So here's the S&P here. We're going to rotate to a relative call. So if the S&P was flat, up 3% mid caps outperformed by 0.25%, small caps outperformed by 1.6%, micro caps outperformed the S&P by 2.5% this week. On the downside, global markets actually underperformed as a whole, with EFA underperforming by 0.5%, EM down 0.8%, and frontier markets up just a little rounding error. So, this week, for example, actually, the S&P was up overall, again, finishing weaker today, but overall up from last Friday's close. And worth noting that small caps and micro caps actually handily outperformed large caps over that period. Finally, we're just going to look at a sector performance. So all using the perf charts, which is basically a performance chart where you look at a period of time and then you set the schedule. So you set the time frame. So here the S&P was up 3.7% in the last week. Let's stabilize that. We've now normalized to that value, and we can see what sectors have outperformed or underperformed for the last 5 days. Top sectors this week were technology, materials, financials. On the downside, utilities were the biggest loser, underperforming by 3%, followed by healthcare, and followed by staples. So it's interesting that consumer discretionary, which had been an interesting emerging theme up until last week, I feel like that's come off a little bit with other sectors sort of rotating around that. And technology is certainly the biggest winner. Tech, I think, we were starting to see a potential rotation away from technology. It felt like maybe that was ending. But this week, I think in terms of what we learned, semiconductors, resilient, outperforming. The XLK as a whole, resilient, continuing to outperform. So in terms of a safe haven during this period of uncertainty, tech certainly appears to be continuing to fill that role. Let's switch gears and go to the Mindful Investor Live chart list. This is what we love to do every Friday. Start at the top and go down through it. So I update these charts at the end of the day. I have not done it yet today, but what's interesting is as of this moment, as of Friday's close, all three of these trend following devices that I follow using the weekly chart, all positive now. So the long-term model now has confirmed a positive reading, and this is based on the 21 and 34 week exponential averages. The medium term, which is using the weekly PPO, has been positive since early May and remains so. The short term, what I use is just look at the change in that and the gap between these moving averages, just a short term read, and that has turned positive as well, just with this week closing above last week. So, if you look at the weekly chart, it doesn't look as bad as I feel like on the daily chart, right? Because on the daily chart, you're getting the intraday movements. You're seeing how we're closing below the open so much in the last week and a half. And for me, I think that's a big part of how this environment has felt, even though we're up Friday to Friday, this Friday from last Friday. Overall, it's the distribution during the day that feels more negative. If you look at the bar chart, it's actually more of a positive read. It's not quite closing halfway through the previous bar, which would make it a bullish candle pattern. We didn't really get that. We closed just below halfway above yesterday's body, the open to close range from last week. But overall, certainly trading higher during the week, trading off of these long-term moving averages. So the long-term trend remains positive, I think, by that read. The daily chart we've talked about, a bit of a distribution day. This looks a bit like a bearish engulfing pattern. It's not as idealized for me because that you'd really want to see after the end of a big move. This is sort of in the middle of a congestion range. I don't think you can make it feel as much of a bearish engulfing pattern, but I do very much notice the potential for a lower high here in that 3150 level. Going into next week, I think that's a level I'll certainly be paying attention to, not just on the broad market standpoint, but also looking at individual stocks and seeing if they're able to break above the swing highs that we set this week. This was a chart that we talked about on our 3 and 3 yesterday, which is the cumulative advanced decline lines. It's too early to certainly say this is a bearish signal, so don't misinterpret. I'm not saying this is a sell signal of sorts. I'm anticipating when we potentially would get some sort of divergence or some sort of distribution. For me, when this indicator is making higher highs and higher lows, when it's in an uptrend, the breadth overall remains positive. It's interesting to note that this week they've all appeared to have set a lower high. That could change next week. If we rip, this will just look like a continuation pattern. So it's too early. What would not make it too early and would confirm that as a lower peak in a distribution is if we break below the peak that we set from last Thursday's sell-offs. This is the distribution you saw last Thursday across the board here, large to small. And if we would break below that next week, that would certainly make the breadth picture turn more negative. Has not been the case. Very few new highs, very few new lows, if not zero new lows. I mean, it's been on your hand, you could count the number of new lows on any given day. It's been minimal on the S&P 500, and that's because most stocks are in this range, right, between their 52-week highs and lows. I think it is worth noting, though, during this whole period over the last month, you have had stocks breaking to new highs. It's things like Shopify and KLAC and all these other names that we've talked about on the show. Yesterday, if you missed it, we talked about stocks breaking above their upper Bollinger Bands. A lot of names making new 52-week highs or close to that metric. Those are the names that would appear on here as stocks making new 52-week highs. So they are out there. You have to screen for them. You have to look for them because the broad market index is still not there. The next chart we've talked about a couple times this week, and this is the percent of stocks above key moving averages. For me, we remain below the 50% line. This is the percent of stocks above their 200-day. This is not quite updated for today yet. I don't see that changing, though, based on how the market, sort of distributed during the course of the trading day today. But overall, if and when this remains above 50%, that tends to be more of the bullish range. That's where bull markets tend to be. When we're below 50%, that tends to be the bearish phases. And so right now we've had whipsawed. We whipsawed above the 50% line, and now we're back below. So as long as that remains below, I'm sort of thinking, leaning more negative looking at that particular read. In terms of the sentiment, just one thing to point out, the AAII ratings, we talked about this yesterday, rotated in a big way, almost a 20% rotation from people moving from the bullish vote to the bearish vote. That's a big shift. And I think a lot of that, obviously, a reaction to last Thursday's sell-off. This comes out every Thursday, so it could be any time between those two Thursdays that you had the reaction to that, but certainly rotating more toward the bearish side. It's almost 50% bears in the AAII survey, which tends to coincide with previous, pullback lows, but it also coincides with the beginning of much deeper corrections, which is why I can't go out and say that's a huge raging buy signal of sorts, but it's certainly worth noting and worth tracking. The final chart we have time for to wrap the week is looking at this chart in particular. This is the ratio of consumer discretionary versus consumer staples, potentially putting in a lower high, potentially rolling over to not quite break down today. But I think it's worth noting on an equal weighted basis, we have already broken down, suggesting a rotation away from consumer discretionary. And this is a ratio looking at consumer discretionary versus technology, never really broke to a new swing high and now coming off a little bit, just speaking to, again, the resilience, the outperformance of the technology sector.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.